So let me start with setting a few context for this. So as both of you might be aware, India is one of the most vibrant fintech ecosystems globally. And today, if you look at how fintechs contribute to the banking ecosystem, in terms of revenue, today fintechs in India contribute to close to 67% of the overall revenue from the banking ecosystem. But the expectation is that over the next few years, by 2030, it will become around 20%. Just significant, it makes index significant in the overall last few of things. Beyond revenues, one of the reasons why everybody is looking at fintechs very closely is because there is at least a thought process that fintechs are basically focusing on segments who do not have access to credit. They actually will lead to more financial inclusion and thereby driving economic growth. So that in that context, today's discussion becomes very good. What I do is let me start with just questioning the topic itself. The topic is basically saying that okay, but I just want to push that thought a bit because I've heard both sides of the story. So I just want to start with Abhijit and Sudipta and basically hear your thoughts in terms of in what ways are or do we believe that digital lending platforms are driving credit access to it? Is it in terms of giving access to customers who does not have access to credit today because of distribution? Or is it because of, let's say, fintechs being able to leverage alternate data and hence basically get new credit to customers who would ideally get from a normal bank or NBFC? Just want to just hear your thoughts from two angles. One, from your perspective, as a pay cards, you would focus on more prestige customers, I would say in that sense, whereas Deepa, you as an NBFC focus on customers of last mile and basically provide customers who want to give you to credit, etc. Just want to get from both perspectives, how do you see the role of digital lending platforms in terms of actually driving credit access, especially for customer segments and customer section who does not have access to credit. Maybe we start with Abhijit.
Yeah. So let's the context part in mobile. There is a question and raises another question. That why do we discuss this topic? And what relates to the digital lending platforms have. I think all of us here will agree that the ecosystem never had its problem. Whether the whether the regulators, whether the beneficiaries, and the borrowers, all of them taken together, we never had its problem. We all know the penetration that is taken place through the fintechs. The traditional financial institutions do their brick and mortar arrangements, and today all of them for so many years now also have their own digital lending platforms also. But their enterprise fintechs have the ability to look at the alternative. Somewhere, the traditional financial institutions did not have that kind of abilities. And everybody, end of the day, the traditional are force. So with that, ability of fintechs to look at the alternate data and create and look at a new customer database that created a new IP. The politics level. Question is, we discuss is something that process going a bit off path here and there. Otherwise, we won't have to discuss it. We won't have been happy with the going. So, there comes the question that how fintechs have created the enablers is largely on the onboarding side. But the day it's a regulated entities or the entities holding the loan book that we are who need to maintain the portfolio, and to what extent the capabilities post onboarding maintaining the portfolio that is that creates a problem. And so far as your reference to the implementation is concerned, the worst may be that until we have whether the maintenance and the entities partnering with them, or even the entities who have their own platforms together, whether they have created an approach slightly uns, while it is unpredictable, whether a bit of risky segment, well, traditional bankers or traditional are not able to take that risk. If the risk enablers have been mitigated to a larger extent, why not? So digital lending, in my opinion, is here to stay. But based on the experience that has come over the years, there are a bit of course correction required. That can always happen. But there is no going back from it.
Sudipta, I think you mentioned, I think he has built it by yourself and basically has been driving the market. Just want to get your thoughts in terms of how does that help you basically driving more trend for customers?
So, I just take a little bit from here and then come to your question. I think if you look at the current fintech concept, starting with the 15 years into it, I think current sees a couple of pieces of it, right? And probably might sound a bit contrarian, but fintech's bets on balance sheet growth is not really. Fintech's bets on experience and fintech's bets on data has not. And the more fintechs have really realized now that partnering with large players who have balance sheet strength and working on the outside on the experience and the data and the underwriting side is probably the best way to go. But actually, you share the risk with somebody rather than trying to take the risk on the balance sheet, because the risk on the balance sheet does not turn out, because at the end of the day, we should forget at any moment, final thing in lending is connections, right? And frankly, most fintechs are illegal to deal with the sort of the sideways grunt work of collections. So I think that this is a well put that the entire fintech ecosystem is gearing towards that. Maybe even later can add to that. One of the things that we have been trying to do is that the logical question initially was alternate data, right? And what we have been trying to do, basically we pride ourselves as one of those sort of large PFCs who actually have been trying to revive a sort of fintech team, trying to build our solutions in. And earlier, we have realized that, apart from the traditional methods of underwriting that came here, if we put the new underwriting sort of pipelines into listed data, as well as the consent given on the configurator. So, if you are able to put all those together and push them through one single underwriting point, then the underwriting becomes an order of magnitude stronger, especially for you. Right? And if you look at our two levels, largest financial or two-wheelers in the country, 40% of our two-wheeler customers are into, which is an area banks don't get into, which is an area some fintech get into, but certainly don't get into. Once we started putting our new underwriting units, we launched in the month of June. And when we looked at the June underwriting data using Bureau, the line aggregator, using what I call pass signals from 8 different sources in one single pass, the order of results are significantly. Right? So, obviously, the fintech ecosystem that has been built over the last 15 years has now matured to a certain extent that they are able to value add to the alternative fund. And it is up to the intelligent lenders to plug into this fund and see how you can sort of stand on top of it and make your alternative fund And that's what I think the entire ecosystem of vendors, it takes as well as the regulators for you have access to listed data, right? Only again, you have access to tax information data, only again. I think this thing is still playing out. We have a little more to go, but it is my firm belief that in next 2 to 3 years, underwriting in India will become so strong that dodgy credit will just come.
As easy to work with many of the fintechs, both client as well as banks and NBFCs. I think on the credit access side, or capabilities, etc. I think they definitely move it. Doesn't mean that digital is not a matter of ground. Digital is a pan-India government, whether it is tier 2, 3, 4, etc. I think digital platforms actually helps us to provide that access to those customers in a profile where a branch presence cannot be vital from economic perspective. And similarly like you rightly said, on the underwriting side as well, more than 40% customers who are underwritten by fintech. In that sense, they actually enable the revenue in those systems. Now let me talk to Hemant. I think Hemant, on the consumer side, there has been a lot of success on the fintech side, consumer lending side. But at least on the MSME lending side, it has not been that relative. Right? And one of the things which leads to economic growth is MSME lending. Just want to get your thoughts on that. PhonePe. How do you think about enabling credit for your merchants or the ecosystem or other MSMEs, which actually boost the economic growth?
So actually for us, last 6-7 years have been an amazing discovery. Trying to understand what really the MSME, SME really means. And beyond that, the real understanding is it's not just MSME and SME, it's also the micro merchants and it's also the informal micro merchants. And sometimes back we also recognized as IMEs last year or I think earlier this year. But there is a vast segment of SME gets classified. If you just look at some numbers, right? Broad estimates of whatever political people have multiple agencies have collected or governments put out. Roughly there are about 6.4, 6.5 crores MSME, SME, IT merchants. Of those, roughly around 6.3 crores get classified between micro merchants and informal micro merchants, IMEs. So 90% plus are the ones, in fact 95% plus are the ones who are in the very small segment. And if you look at it, if I share some of the data points, our discovery is 50% plus are in the rural regions. They are not in the urban segment. So when we look at SME and MSME and when we look at doing all of this, that's been the discovery. The part to that right now, because the broadly addressable market on MSME right now seems to be about $300 billion. But at various estimates, but roughly around 20% of the needs of what in India needs. India needs about $1,500–$1,600 billion of MSME credit. That's how large the gap is. In there, the real play comes in because there is a great opportunity in what we've seen happening right now. There is digitization that has happened at the merchant level, at the micro merchant level. They have adopted to digital platforms, digital payments. There are digital platforms and digital infrastructure which has got created, which gives GSTIN or they're not in the GSTIN, just being able to kind of do KYC, to be able to understand their documents, to be able to look at all of it, because 90% plus of them are proprietors. So if they are proprietors, you need to really rethink on how are you going to be lending them. And that is where the formalization of how the segment operates is really critical, which is taking shape. They are understanding of how to play around in the digital space to apply digital or to kind of do their KYC application digitally in that way. There's a network effect which also needs to be created. So millions and millions of merchants who now come on the digital side is also enabling a lot of SME. The last thing that I would say in this is that there is also a need to really rethink that classical lending model might not really apply because each of these segments of merchants, their needs are very different. Some might need working capital, some might need inventory financing, some might need just the day-to-day capital to meet their standalone business needs. So when the repayment is also very different. As example, some might want to pay on monthly basis, some might want to pay on a higher frequency. Their flows, inflows, and outflows are very dynamic. So how do you kind of shape products? Is going to be happening. I think that is all taking shape now. And There is now an access to this merchant because of digital payments. There is good understanding of how their business is really beyond cash. Now the digital side, how is it playing out, and there's an estimate that you can be on top of this. And what's the size of this, and how do you kind of underwrite merchant NDC merchant? And lastly, there's ability to reach out. So there's reach, there's tech investments which everyone's making, financial distribution. We ourselves are working with them and trying to correct this. So it is a multi-variable problem, but we're getting it.
So, Kumar, you have been a veteran banker for a long time. Now you are seeing in context. So, what do you think will take for digital lending to basically take permanent long as well? What are the enablers which industry needs to make us happen?
So we don't space. The simple reason that they have created a big plan last time. Number one, the opportunity for reaching that last point. And there's always a same like the MSME and the consumer, where we have succeeded so far. You believe that you just tell it to me. The logistics which is required by the end consumer, he wants to win. Under the logistics, there is a leader who gets no leader, exactly the opposite of this. It is something he is manufacturing there, and to the consumer who is not starting India, who is not being spent. The first and foremost where we have to bridge the gap is how this funding is not right. Credit code in one and controlling that credit to the credit, getting it into a traditional risk assessment and to the logistic purpose of that, working that human credit, human going patient. Whether that play a digital going to because of management, yes. It is not the credit access and digital platform. We have a collaboration between consumers. And the traditional bankers, you can't say that. That's what we said. Every SME needs a different way. You can't have a rule-based meeting or must be for manufacturing and special sector. And even within the sector also, it is not going to be the same, but different geographies. Deciding the input cost. See, this is going to be a unique model, and whether one single model is going to one size fits all will not be applicable as far as business. It can be divided into multiple pockets. The pocket number one is facilitating the access to that end person who is area of tier 2, tier 3. You may not have tier 1 bank. Yes. That's the first one. The second is underwriting cannot be done on the pure play. Assessment based lending, which is the only thing is that digital can't be totally digital. The digital is going to be a bit different as far as MSME is concerned. Possibly the last way the credit underwriter may have to have what is a PD, microfinance, that can have videograph, and ask you to sort the house, and things like that. But it's not going to work like that. So there has to be a difference. Will I be able to give the loan in 4 hours and 5 hours, 6 hours? Those timeline is going to drop down the banks. We can't. If it is that, it is going to become a very big question on scalability is not a question. Stability. And how you are going to financially stable as we move forward. That's what it is. And sustainability. These two questions, if you wanted to answer, it has to be finished. And the second important bucket just to be solved the collaboration between the credit fintech, that of the logistic fintech. How do I facilitate that producers to be reach the market where there is a demand? This we are able to predict is a huge scope. And of course, as you were telling it, a lot of work going on. Hemant is known for forward looking as far as this is concerned. We always do certain investment in this area. We are working to understand that how we can bridge the gap which we have identified from the finance side. Of course, everything comes under the one single umbrella of compliance, and we need to have an appropriate guardrails. The doing a consumable digital is by default is getting into this guardrail easier, whereas an MSME is going to be a little tougher. If you are able to bridge all these four different vertical gaps, it's a huge market. And this is something, one of the assessment I remember I read somewhere, the gap for MSME lending today in the formal sector is 25 lakh crore. So imagine the opportunity which is lying in front of us. This is today is being catered to. It's not that the people are not getting it. It's being formal sector, and that is where the delinquency is. They are not able to see their life out. They borrow 100 rupees, they make 100 rupees, and then pay it. But coming to the formal sector, formalization, as I said, if it happens, possibly that growth will be in a geometrical progression.
Yeah. Thank you so much. Let me come back to Hemant. Let me look at another axis now. We spoke about consumer and MSME. The other axis I want to look at is the type of loan which is being facilitated right now. A large part of the loans which is facilitated by digital lending platforms are unsecured loans. And unsecured loans as a proportion of retail credit might be 15% or 20%, not more than that. So I know PhonePe, you have been trying to get into other product lines, like for example, two-wheeler, some bit of other products, etc. I just wanted to hear your experience. How has been the experience on driving other or asset-backed lending on digital lending platform? What's been the experience? What are some of the learnings you have?
I think we are right at the stage where the asset-backed lending or the secured lending, as we call it, is going to be opening up a big way on the digital side. But every product category is very unique. The asset-backed lending side. Some of it would be very hybrid. Some of it would be completely as an opportunity, and some would be a very mix of something that, like for example, mortgages. You need to kind of do a lot of work beyond sanctioning and understanding what the asset is and how do you get the line to. But as against that, say a loan against mutual funds, something which is there's an immense amount of investments that's happening, 20 or 20,000 crores of SIP every month. And that process is now completely mature where the application to application could happen digitally. So there are lenders who want the incidence of where the need is. Like for example, loan for against gold. It's difficult for them to reach out, but they need to find out where the real need is. It's like the needle in the haystack. So for us to be able to kind of discover that for the lender, so one side is a complete digital side where few products could move in, maybe the two-wheeler, four-wheeler could move in that direction. Where for example in insurance today, when we are doing insurance, there is, if your policy expires, there is a break-in concept of break-in and needs physical inspection. For most of our partners, we made it digital. So customer actually takes the video and submits it, and they look at it and they kind of underwrite basis that. So if two-wheeler and four-wheeler can go in that direction where they at least need to understand the asset can do it. Mutual funds is completely right and getting in there. Other products will catch up, but it will be a combination of digital plus a hybrid. But I think we are right at the stage. In the next 2-3 years, there's a lot of investment being made by NBFCs, by financial institutions, banks to kind of make it more accessible and easier for us.
Yeah. Thank you, Hemant. I think let me come to Abhijit now. Abhijit, on the regulatory side, RBI has been quite active in terms of looking at how the digital lending has been happening in the country and coming with multiple regulations over the last few quarters, I would say, starting with digital lending guidelines. Just wanted to get your thoughts in terms of what has been your experience or what impact have you seen this on the industry? And do you really believe that will it enable more of or will it make the fintech more successful, or do you think it's going to hamper the innovation in the industry? Because Mr. Kumar spoke about everything has been done in compliance, because that becomes important. It's not just enough that we lend, but it also has to be done while keeping in mind the risk plus compliance / regulations in mind, right? In that context, I just want to get your thoughts in terms of what's been the experience so far of the regulations which came in over the last few quarters.
So when we see the regulations coming in, while highway was there, whether there was whether there was a runaway speed, somewhere suddenly found a regulation about digital lending. And all of us have seen the guidelines, all of us have been working on it. Now, there are two parts. If we look at the digital lending guidelines, we have to look at the combination, whether what impact does it have on the regulated entities or their own platforms or regulating entities who have fintechs funding. So the guidelines made very clear where the responsibility lies, what were the what are the security mechanisms that need to be in place, what will be the governance around it. We saw the latest where uh, where we are heading now, the latest guideline on the block, management of modern risk. Now, we starting from digital lending, now we have reached a stage where regulator is now going to look at there comes the biggest challenge for the entire ecosystem. Because, as I said in the beginning, if we are discussing it today as a topic, then there must be something to discuss about. There is something definitely not acceptable in entirety to the regulator. That's where we have one guideline out there. If that is so, and if we have to look at our models, then that will come as a challenge. Because as the regulated entities as well as the fintechs, everybody has a different risk appetite. Everybody has a different target. It's not everybody walks into every geography, every segment of borrowers. Now, but then if RBI says that the objective of the model has to be there in the definition and models have to be validated, models will be reviewed, so the models can be questioned also. There comes the real challenge for the entire ecosystem. If any one of us were having policies which may not be acceptable to RBI when they look at the models and start questioning it, then we will have to post it. And I don't think it will really impact in a big way. Only thing is, probably all of us together will become more aligned to the regulator's expectation. Will bring more sanity to the system. And end of the day, what Sudipta very subtly referred, the collections. Collections comes at the end of the entire cycle. And probably the regulator has started from there. We know what is prevailing in the ecosystem so far as, and most of this digital lending leads to unsecured. It's related to the unsecured. So we see there is a buzz around it. So regulator is aware about it, and that's where they have started from that end, looking at the collections, looking at the delinquencies, looking at the over leveraging that might have got created because of this. Ultimately, they are now questioning the points.
Yeah, no, absolutely. I think it's critical. See, like you said, when we were innovating and building new businesses, there was some leeway. But now it's time that fintechs are becoming significant for the ecosystem. So it becomes important that we also look at what practices are being done by fintech so that there's no impact on the overall banking ecosystem from a risk perspective. So it makes complete sense. Let me come to Mr. Kumar. I think somebody raised in that discussion that fintechs can't exist independently. Because a lot of the things which digital lending platforms and fintechs do today is with the support of what is regulated entities or banks or NBFCs, etc. Just want to check, just want to get your thoughts in terms of how can banks, NBFCs, etc. help the digital lending platforms and basically taking it further, the inclusion and the credit access, etc. Any thoughts on that?
Right. One of the common questions which always come up. The moment you just step out of the competition board and say that innovation is the key. The innovation is a must for if you wanted to scale. And should it stop only with the scale or should it sustain and financial stability is something? That's where the regulator is stepping in. Like why the regulator steps in? When the audience is larger, right, you have a greater responsibility to ensure that the larger audience invest on it. They will get the back. They will be plans. But nobody is having a third of their understanding. But the moment it comes out to the level of larger audience, naturally, the moment these guardrails are being, you may ask, why can't we make it work? It's a question of the vetting the innovation mindset of the guardrails. There will always be competing for themselves. Allow the innovation to come out, collaborate with somebody who's already traditional way of doing it. To be able to get the best result of it, which is going to address the audience. The reach is possible through digital platform. So onboarding is possible through digital platform. But the moment we have collaborated experience in the back end, risk undertaking, risk assessment, you will be in the position to work with some established. And these two things are required to solve the problem of the customer at the end of the day. The journey of the customer digital journey is most important. What did you want to why the banks are not able to predict it? It's mainly because we have not considered that then at the end of the tunnel, what is required. So if these two are able to collaborate with each other and respect each other's domain expertise and share the risk very seamlessly. But if you partner, one of the things which is required for volunteering and co-branding, whatever it is, the moment you are able to respect the respective guardrail governing that particular thing and also share the risk seamlessly, there has to be something that
Thank you so much. My last question is so, digital lending platform, while many influencers started taking, I think the lead has been taken by fintechs in the early days. What are some of the learnings which influencers like NBFCs and banks can basically take from fintechs and incorporate it into your business model, your thinking, etc., which basically help us increase the scale of this business?
See, I think three things you have to keep in mind while you look at it. First is obviously the ease of the customer experience of the user experience. That's the first thing that you have to look at. The second thing that you have to look at is the credit acquisition. So the credit acquisition models are the way you are doing it is traditional or the way you are doing is different. And last but not the least, in terms of the credit outcome or in terms of the portfolio management outcomes, that you have to look at. Now, one of the things that the fintechs have done really well is making the user experience. So obviously, the user experience again, there is a thought process out here is that does regulation add friction to user experience or does regulation really stymie a fantastic user experience? Now, if you look at the user experience in Western countries where much of the KYC methods of KYC is trust based, right? There is no formal structure around it, right? And the fact is that if you lie, then the penalties are very serious. So generally, people do not lie. But in our country, obviously, the KYC framework administration is far more stronger. And sometimes it is told that the process of onboarding or the process of user experience, because of regulation on KYC and because of a regulation on disclosure, there is a lot of friction in the process. Some of the I think in our country, primarily because of the sort of the India stack, I think that process or the friction on that process to a certain extent has been addressed. And last but obviously the last missing mile was video KYC, which I think is pretty standard. An average video KYC is getting done into 5-6 minutes. So that part everyone has solved. The second part, which is basically the credit underwriting, I think it is still a work in progress. And I say this with great deliberation that the traditional methods of credit underwriting is dead. And this is dead for both banks and dead for both fintechs because the traditional methods of credit underwriting is post-event. That means after the event has happened, you are waiting for the thing to get reported to the bureau and then you are underwriting on that. While you are underwriting at this point in time, an event might be had. I'll give you a simple example. For example, when we look at account aggregator data and when we do analysis, we find that people or individuals who are far more engaged in, participating in the sort of the betting apps or the gaming apps tend to have 3 times more loss rates than people who don't do that. Now the question is that is it discriminatory? Probably it is discriminatory, but the fact is that the data is there, right? And the fact is that as a lender, you are supposed to look at granular data which is flowing through the systems right now and then take your credit decisions. post-facto models of underwriting both for banks and fintechs are there. So the new method of underwriting has to be adopted and has to be faster. Fintechs are a little ahead on this race, and I would say banks and traditional financial service industry are absolutely at the sort of the back of this particular. Last but not the least, portfolio management is something in which fintechs are currently weak, and the traditional lending organizations are far stronger. So, for all these three to harmonize and come to a particular level, when the entire ecosystem is moving at a similar pace, right, and there are the discrepancies between this modalities of administration of this particular three main areas of financial services lending is something that are work in progress, and I do believe that in the next couple of years the gaps will reduce. That's when we will see probably an unified lending sort of culture.
Thank you. I think that's all from my side. Any question from the audience? One or two questions. I don't think we have much time, but.
My name is Jen. My question is beyond KYC, do you see a lot of technology in identifying to credit borrowers and put digital lending therefore make it more inclusive for global south?
Beyond KYC, you are in a position to go to KYCD for politics, more the customer's business. So that is where the additional data is going to come into play, your GST data available. Those things will be in a position to make more KYC. The moment you are able to track that deep part of it very efficiently, very effectively, and I'm sure that having tracked the KYC and stuff like that, you'll be able to come up with a model which will be able to make it better.
I'll also take a sort of attempt at answering the question. You know, one of the, apart from KYC, which is pretty standardized in India right now thanks to India Stack, one of the biggest unknowns is measuring the income of the customer to a large degree of certainty, right? And in India, the salaried segment income estimation is quite certain. It is a large long tail of the SME and the micro SME and the merchants that Hemant talked about. That is where income estimation is really a challenge. And I'll give you one other challenge more than that. Estimating rural income is even more difficult than that. Estimating vagaries of rural income is even more difficult than that. And the fact is that this all depends on the digital footprint of the customer, right? So, for example, for a merchant or a micro SME, if the digital footprint is less, your chances of estimating income to a large degree of certainty is lesser. For a rural customer, it is really, minuscule digital footprint. How do you measure it? So I think these are hard problems to solve. And for me, solving for rural income certainty is the hardest problem in the country that we need to solve. Right? So yes, technology has a huge sort of role to play in this. And hopefully in the next couple of years, solutions will be.
Said one sentence in there. On 20,000 feet view, right? Digital is not specifically fintech. Digital is a DNA. And when you see DNA, it's becoming a DNA of the country, the organization, of the individuals. Everyone's comfortable applying digitally, everyone's comfortable doing KYC, e-sign, Aadhaar, verification digitally. So it's become the DNA of the country. So everyone's thinking digital first. That is the bigger change, and that will lead to everything changing. We're seeing that. So now we're at a stage where we're not resisting digital or catching up. We are forward looking. Everyone's forward looking, saying what more can I do? That is the big change happening in the country.
Yeah, I add to what Hemant said, we are the largest tractor lender in the country. When we started video PD for tractor customers, my team was skeptical, saying that right? When we started the video PD of tractor customers, tractor customers, farmers are doing video PD. So the fact is that it's happening.
Everyone's moving way faster than what we think sitting here in Mumbai discussing this, that segment is amazing.
I think we are almost on time, so sit here. I'll just I am very hopeful and very glad to see that these best minds are here. I have one question because there is a new element in Unified Lending Interface, NPCI. So, how do you see it is going to assist the lending ecosystem in the country, and how do you see your respective organization helping on that or leveraging on that
technology stack. I worked with 22nd answer. Please just believe that one of the things that unified lending interface tries to bring is access to that of unavailable automated data. Right? The mainstream data is available, but ULI plans to give access to GST data, plans to access to give NDDB data, monitoring data, etc. So overall, I think the pools of data which will be available will make the decision of underwriting far more stronger, especially in the semi-urban and the rural spaces. So, and flow of credit to semi-urban and rural is far lesser than urban spaces. So I think the real impact of ULI will be accurate in semi-urban and rural. In urban, I think there is already credit is well.
Let me just add one point. Right? If you look at an Indian merchant today, you will find a Pay sticker, you will find a Google Pay sticker, you might find a Paytm sticker. Challenge is, depending on which layer they are working with, or where the maximum transaction happening, the visibility is just to that. So, for example, if PhonePe has 20% share, then at this point, the income visibility they have is 20%. Just 80% we are estimating. When PCI comes into play, PCI knows 100% of the transaction, at least digital transactions. And today we know large part of the small ticket size payment things that are happening in UPI, which actually significantly improves the quality of data which is available for income estimation of transactions.
Biggest advantage is going to build up the standardization. How today we have a kaleidoscopic view of a borrower. I view him differently and rejecting somebody else viewing it differently. It is going to go out and go to then it is an efficiency which is going to play. Then the risk appetite is going to play. Because at the end of the day, my risk appetite will be great. So that standardization puts on a simple reason. The scale which we are seeing it is going to be double. That will be game changer.
And somewhere multiplicity of different fintechs used by parties source their different services, be it invoicing, be it marketing, be it distributing, which many of their parties don't have. Now, if all that is coming to one platform, somewhere the multiplicity of these services so you have access to various data on one platform along with the data through which you can impute the income, then you have a one-stop solution.
We should all be proud of it. The one last point is that really be happy about is that we are seeing an era of digital public infrastructure which nowhere in the world is happening. So and we are all at the center of it right now. This is also a step in that direction.
So, thank you so much all the panelists as well as audience.